Hello, this is Mark Soberman, and in this video what I wanted to do is just have a real quick conversation with some of you, and I want to talk a little bit about curve fitting and optimizing your strategy. And this is something that early in my trading career that I kind of fell victim to, and it definitely cost me a lot of time and a lot of money in the beginning, because I just was of the belief that if you could basically take past data, come up with a set of rules and have a system that was profitable, that it would certainly continue to do that going forward in the future. It just seemed to make logical mathematical sense to me. What I didn't realize that by forcing past data around a set of rules, what I was doing was really curve fitting a strategy. And as soon as I went to go forward and trade in real time, well, nothing was optimized, and no surprise, the strategy totally fell apart. So I'm hoping that for some of you, you're probably shaking your heads and like, yeah, I've been down that road. And others of you have not yet gone down that road and maybe are really thinking about it. And in fact, you may have bought things that have some pretty spectacular back-tested results, and they win theoretically 95% of the time. And I'm just kind of here to tell you that the reality of what's going to happen in real time is you're not going to come close to being able to achieve those sort of numbers, especially if you know that that strategy has been optimized on a certain market or time frame. I think that's the dead giveaway when that's happened. And this reminded me because when I was at the trade show recently, I was talking to a trader, and he told me, and he had a very similar situation to what you see here on the chart, where this is a Russell E-mini chart, where theoretically we have an opportunity to buy here at 568.20, and you'll notice the high on this candle is 568.20, and that was it. After that, the market went down, and you would have stopped out. I mean, nobody likes to stop out, but it's part of trading. I mean, it's a very continual, constant part of anybody's trading plan who's actually profitable. That might surprise you, because most people probably think stopping out is not part of successful traders' track records or part of their performance, but actually it is. I mean, it's something that we all just expect to have to deal with on a regular basis. We definitely want to have many more trades that are profitable than are not, but it's still the reality of trading. Now, what he was telling me is he had a situation like this in the forex market. So very similar thing. He goes, I just got triggered in, and this was on the move, if you remember this a few days ago, where we had that huge run up in some of the forex pairs, the pound yen, the euro yen, the pound US, and he actually got in on a short. So he got crushed, right, pretty good. And he basically said it was this kind of situation where he got, in this case, short on a low tick, and then it took off to the upside. So what his solution was this. He was basically going to add on some additional confirmations next time and get short a little further down. And the first thing that I said was, did you then go ahead and take that new rule and test it back on data in the past, like for the last 30 days or 90 days? I mean, have you just at least back tested, forget curve fitting? And the answer was no. He just kind of felt like, well, like in this situation, if I would have just added a little something to our rule and pushed up the entry another tick, I could have removed this long and this loss. And that's what people who curve fit and optimize do. They constantly try to basically explain away the loss and change the rules to get rid of the loss that may have happened. Even on a case of here, if this market bounces back, they would just move the short further down and say, okay, next time I need another point before I get short. But the moment you do that, you fix your current problem, and yes, you do get rid of your short or your long or your trade that doesn't work, and you find yourself in the exact same problem going forward, because then it turns out that additional point adjustment causes you not to be able to capture a target because you got in too late on the next trade in real time. So it's a vicious cycle. The way to avoid that is number one. Yes, it's important to definitely test and to back test and to get confidence in your system. But what you don't want to do is constantly be changing the rules to tweak and adapt and get rid of losing trades. Okay, I mean, clearly you got to avoid losses as much as possible, but you can't go down the road of optimizing and curve fitting a system, because really anybody with a powerful enough computer, which we're just talking a notebook or a PC, can come up with a system that wins 98% of the time in the past. But once obviously you trade that in real time, you'll never be able to replicate that. So try to stay out of that habit if you can. Number one, don't pick up systems like that, that are over-optimized on very specific markets and time frames. They're not going to hold up for you. And definitely number two, don't fall victim to, I guess, quote unquote, freaking out about a few losses here and there and feeling like you need to just change the entire system to make sure that that trade never happens again. You got to get to a point where you sort of accept that that's going to happen at times, and there's no reason to change your rules if the system ultimately is working for you over time. And this really applies to futures, forex, stocks. It doesn't matter what you're trading. All right, so I hope that helps a little bit, and I hope you enjoyed the video. We'll be back with you tomorrow.